Over 90% of small business owners are overpaying their taxes, throwing away thousands of dollars every year. If you're not careful, you could be one of them. In this video, we're breaking down 7 simple steps to help you master your business taxes, avoid penalties, and maximize your deductions for 2024. Let's get started. Understanding taxes is essential for the success of any small business. Taxes aren't something that can be ignored or pushed aside. They directly impact your bottom line. Here's the deal. Taxes for small businesses work by subtracting your expenses from your income. What's left is your taxable income, and that's what you'll be taxed on. The type of business structure you choose plays a major role in how you're taxed. Whether you're a sole proprietor, LLC, or corporation, each structure has its own tax rules, so choosing the right one is key to minimizing tax obligations. Tax penalties can be tough, but they can be avoided with proper planning. Missing deadlines, failing to file, or underpaying estimated taxes will lead to fines. Being proactive, keeping records organized, and making estimated payments throughout the year helps avoid these costly mistakes. Proper tax planning will keep your business running smoothly and out of trouble with the IRS. Step 1. Choose the right business structure. Choosing the right business structure is crucial for how you handle taxes. First, there's the sole proprietorship, which is the easiest to set up. If you're the only owner, you don't need to file any special forms. You simply report your business income and expenses on your personal tax return. Plus, sole proprietors can take advantage of a 20% tax deduction, which can be a big help. Next is the LLC, which is a popular and flexible option. Single-member LLCs also file their taxes through Schedule C, just like a sole proprietorship. The benefit? No double taxation. Plus, if your business has losses, you can claim them to reduce your taxable income. An S corporation is a bit different. Income from the business is passed directly to shareholders, avoiding double taxation. But keep in mind, shareholders have to make quarterly tax payments, which means more frequent planning. Lastly, there's the C corporation. This structure is more common for larger companies. C corporations pay taxes at both the corporate and individual levels, which means double taxation. But it's often appealing for businesses looking to attract investors and focus on long-term growth. Now that you know the structures, let's talk about which tax forms you need to file. Step 2. Understand the key business tax forms. Understanding which tax forms to file for your business is key to staying compliant and avoiding penalties. If you're a sole proprietor or a single-member LLC, you'll file your business income and expenses on Schedule C, which is part of your personal tax return. For partnerships and multi-member LLCs, you'll need to file Form 1065. This form reports the business's income, deductions, and profits, and then each partner reports their share on their personal tax return. If you've structured your business as an S corporation, you'll file Form 1120S. This passes income and deductions through to shareholders, and they report it on their individual returns. For C corporations, you'll file Form 1120. C corporations have double taxation, meaning the business pays taxes, and shareholders pay taxes on dividends. It's crucial to know the due dates. Partnerships, S corporations, and multi-member LLCs must file by March 15th, while sole proprietors and C corporations file by April 15th. If needed, you can file for a tax extension, which gives you more time to file the return. But keep in mind, an extension doesn't extend the payment deadline. Got the forms? Let's see how to gather the essential tax info you'll need. Step 3. Gather relevant business tax information. To do your taxes right, gathering accurate business tax information is critical. It starts with keeping precise financial records throughout the year, which helps you maximize deductions and avoid costly mistakes. One of the key documents you need is a profit and loss statement. This report shows your business's total income and expenses, helping you understand your taxable income and ensuring you don't miss out on any valuable deductions. Tools like QuickBooks or other accounting software can make record-keeping a lot easier. These platforms help you organize all your business transactions in one place and generate reports automatically. Staying organized throughout the year makes tax season way less stressful. Remember, the IRS requires you to maintain thorough records. You'll need to provide documentation to support any deductions or credits you claim on your tax return. If you can't back up your claims, you may miss out on thousands in deductions. And worse, face penalties. Keeping track of receipts, invoices, and other financial documents will protect you and your business from these potential issues. Proper records aren't just helpful, they're required. Keeping your financials together ensures a smooth tax process and reduces the chances of IRS troubles. Now that you're organized, it's time to maximize your deductions. Step 4. Maximize your deductions. Maximizing your deductions is one of the best ways to lower your tax bill. Deductions reduce your taxable income, which means the more you claim, the less you pay in taxes. There are plenty of business expenses you can write off, and understanding which ones apply to you is key. Common deductions include things like advertising, wages, travel, meals, equipment, and supplies. For instance, if you use a vehicle for your business, you can deduct either the mileage or actual expenses like gas and repairs. If you're a new business, you can deduct startup costs. These might include office space, insurance, legal fees, and even the cost of designing a logo or printing business cards. If you work from home, you may be eligible for the home office deduction. To claim this, the space must be used exclusively and regularly for your business. It can be a great way to reduce your tax burden, but you need to follow the rules closely. There are also less obvious deductions that many business owners miss. Expenses like professional development, software subscriptions, and memberships related to your business can be written off. The IRS even allows you to deduct anything considered ordinary and necessary for your trade or business under Section 162 of the tax code. This opens the door to additional deductions you may not have thought about. Keeping track of all these expenses ensures you're not leaving money on the table when tax time comes. With deductions covered, let's discuss paying your estimated quarterly taxes. Step 5. Pay estimated quarterly taxes. If you're a sole proprietor, partner, or S-corporation shareholder, you're required to pay estimated taxes quarterly. This helps the IRS collect taxes throughout the year rather than waiting until you file your annual return. You can calculate how much to pay using Form 1040 ES, which guides you in estimating your tax liability. Keeping up with these payments is essential to avoid penalties for underpayment. Missing quarterly deadlines or underpaying can result in extra fines that will cut into your business profits. A smart way to stay on track is by setting aside a portion of your earnings each quarter specifically for taxes. Many business owners set aside 20 to 30% of their income to cover their tax bill. This way, you're ready when it's time to pay, and you won't be scrambling to find the money at the end of the year. Now, let's look at how to avoid IRS penalties and fines. Step 6. Avoid IRS penalties and fines. Avoiding IRS penalties comes down to staying on top of deadlines. The failure to file penalty happens if you don't file your tax return on time. Filing for an extension gives you extra time to file, usually 6 months, but you must do this before the original deadline. The failure to pay penalty is for not paying your taxes by the due date, even if you file for an extension. Extensions only give you more time to file, not more time to pay. To avoid this penalty, ensure you pay your taxes by the original deadline. If you underpay your estimated taxes during the year, you may face another penalty. To avoid this, make regular payments each quarter. Setting reminders or using automatic transfers can help you keep up with estimated payments, so you don't fall behind and end up paying more than you need to. Finally, let's explore how you can remove IRS penalties and get tax-saving tips. Step 7. How to remove IRS penalties and final tax-saving tips. If you've been hit with penalties, the first-time penalty waiver is a great way to have them removed. This waiver is a one-time courtesy for businesses in good standing and can help erase penalties for late filing, failure to pay, or underpayment of estimated taxes. All you need to do is contact the IRS and request it. For repeat offenses, the IRS offers other forms of penalty abatement, such as for reasonable cause or financial hardship, which can also help reduce penalties if you qualify. To avoid penalties and reduce your tax bill, focus on choosing the right business structure, keeping accurate records, maximizing deductions, and paying estimated taxes on time. For more complex tax planning, working with a tax professional can make a big difference. Finally, keep an eye on changing tax laws, including updates for 2024, to make sure you're saving as much as possible and staying compliant. What's the most unexpected business expense you've been able to write off? Drop it in the comments below. If this video helps, hit like, share it with other small business owners, and don't forget to subscribe and tap the notification bell so you don't miss our future guides. Thanks for watching.